Good afternoon, everyone. Welcome to Insurance 101, What Nonprofits Need to Know. My name is Ling, and I'm the Membership Director with California Association of Nonprofits, CalNonprofits for short. This webinar is organized by CalNonprofits and our insurance subsidiary called CalNonprofits Insurance Services, or CNIS. Next, to kick off the webinar, CalNonprofits CEO Jen Masaoka will share about our organization and introduce our speakers. Take it away, Jen.
Thanks. Okay, congratulations, first of all, to everybody for being exactly on time. You know, that never happens in an in-person meeting, so it's just fun to have that happen here these days when we're on Zoom. Maybe you can just take down this slide and we can just, yeah, that's fine, or yeah, either way. I just want to say a couple of introductory comments. So first of all, you know, for most nonprofits, insurance is the third biggest expense, right? Our two biggest ones are typically salaries. First, second, rent and facilities, and third, insurance. And yet, you know, compared to the amount of time and energy we put into understanding our rent and our salaries, we don't spend as much attention often on insurance. And when we do turn our attention to insurance, typically the only question we want to know is, how can I get it cheap, right? And but I have to say that, you know, whenever we're buying anything, that can't be the only criteria. And let me tell you that I know this from having once chosen a cell phone provider based on the cheapest service. And I look back on that now as basically the year that I didn't have a cell phone, okay? Because there was, it just was like I could never get a signal anywhere. So I appreciate the fact that what we're all trying to do is find some kind of balance between quality and price. But I also wanted to let you know a little bit about CalNonprofits. We're primarily a policy alliance working on policies, public policies that affect nonprofit organizations. And right now, in particular, we're in the middle of a specific campaign bringing 7 bills to the legislature around improving contract payments with nonprofits. And probably any of you who have government grants know how difficult it is to get them to pay on time, to have increases over a period of time, to accept electronic payments, to pay for a reasonable share of their indirect costs. And so we're all trying to address that. And I hope that all of you will consider signing on to our support letter for that. And we'll be putting that information in the chat so that you can do that. We right now have almost 400 nonprofits signed on to the support letter, but we hope we'll have more of you because this is such a pressing, urgent issue, and it affects so many nonprofits. Okay, now just a word about our insurance subsidiary, CalNonprofits Insurance Services, or CNIS, and our two folks, Sarah Matson and Cole Kinney. So CNIS is a full-service insurance broker, and we're very lucky today to have our two top folks from CNIS. CNIS is a staff of 60. And these are two folks that I think are really the best suited to tell everybody kind of what's up and how to think about your insurance and understand it better. And I also really appreciate the fact that both of them are not just people in insurance, but they also, like everybody at CNIS practically, is also a volunteer in nonprofits and has a strong involvement with the nonprofit community. And for example, you know, I know Sarah has served on the for the Girl Scouts and over a period of many years, and also coastal dog owners. Always a good thing to people to help on the dogs issues. No, speaking as a dog owner. And Cole served on the board of Family Service Agency, the San Francisco AIDS Foundation, and many other nonprofit organizations. So I'll turn it over to you. But I also wanted to just say, if any of you have specific concerns about or questions about CalNonprofits policy work, I'm going to put my name and my phone number, my email address in the chat so that you can contact me directly, okay, with any questions or how to be more involved with our policy work. Okay, so take it away, Sarah and Cole.
Thank you, Jan. So good to have everyone here today. I'm from our San Francisco office here with CalNonprofits Insurance Services. Sarah's going to be joining us from our Capitola office. But basically, we're going to be talking about two types of insurance, really just property and casualty, which is my side, and employee benefits, which is Sarah. And we'll give you some buying tips and different things to kind of look for when you're trying to secure the proper insurance for your organization. So what is insurance? It's just a way of transferring risk from one entity to another. In some cases, you're required to have insurance due to a contract or a lease or something like that. But basically, that's all it is. It doesn't get rid of risk. It just basically gives you the ability to stay in business if there's a terrible loss. So risk is basically a chance of loss to your employees, your clients, volunteers, the public, damage to your property, vehicles, theft, fraud, things like that. And some of the ways you can handle the risk are to avoid it. So maybe don't get into a program that may be too risky, reduce, mitigate, transfer, or accept. So a lot of times you may want to transfer certain types of high risk type operations to another entity because you don't want to take those on, or you do need to take those on, so you need to accept them. So what can you do to make sure that you're allowing that risk in the most safe way? So that's kind of what risk is all about. On a contract, an insurance policy is actually a contract. It's between you and the insurance company. There are standard contracts and non-standard contracts. So standard contracts are basically just contracts that many insurance companies all use, where they have the same wording in all the contracts. And then there's non-standard, which include policies like directors and officers liability, professional liability, sexual abuse liability, cyber. Those are all the most typical non-standard lines. So that just means that all those types of policy forms are not going to be the same with every kind of insurance company out there. So it's really important that you look at those, because you're not going to really be able to compare policies unless you really understand what each policy is including and excluding, things like that. So these are the different types of property and casualty coverages. So general liability is basically what everybody needs to run any kind of program. If you're even holding meetings in the community, things like that, general liability is an essential. That's most of the policies that we have will be required by a lease or something like that. And most contracts that you enter into with any organization that requires insurance is always going to request general liability. In some cases, professional liability would be required as well. Sexual abuse, which includes both physical and sexual molestation from a person that works with your organization to a person you serve. Automobile coverage, directors and officers liability, workers' comp, property, and there's all kinds of other coverages, crime, cyber. There's all these other coverages you can look at, workplace violence, all kinds of things like that. So general liability basically covers bodily injury or property damage to a third party. It can pick up things like personal injury, which would be things like libel, slander, defamation of character, advertising injury. Medical payments would be sort of like a goodwill thing that if you had an event, for example, and it was on a lawn and people were walking across it and maybe their shoelaces were untied or something and they tripped and fell, but it wasn't really due to your negligence, that's what medical payments would be. A lot of times we have lots of organizations that have thrift stores. Sometimes we see claims involving someone someone was in a dressing room or something, they tripped and fell and they got hurt. I mean, we don't really know if that really happened, due to your negligence. It's just they got hurt. So they may cover something out of this type of insurance, which carries usually a very low limit. If you're determined legally liable for those injuries or the property damage, that's going to go under the general liability. There's another thing called employee benefit liability. So that's basically insurance for errors you create in the administration of your employee benefit programs. So like the example would be if you didn't offer someone COBRA when they left your employment and there was a claim, or a dependent was requested to be added to your health insurance, group health insurance policy, and the employee gave you the application to send it to the insurance company and you didn't get it in and there was a claim. That's what this would be for. So professional liability basically covers any type of professional service that you provide. So the general liability policy will exclude any kind of professional service, hands down. So types of professional services would be if you're providing services to people in the community, and generally the main thing that you would know that you would need this coverage for is if you're getting paid for a service. So if you're providing social services, if you're providing resources for people in the community, things like that, or medical care, mental health care, things like that. Those are all forms of professional liability coverage. And like the example there, counseling, teaching, advising, those are all reasons for that. Another type of professional liability is medical malpractice, lawyers' liability, things like that. So sexual abuse and physical abuse, molestation, this is a really important coverage to really make sure that you understand what you're buying, because a lot of insurance companies will offer this, but they're definitely not the same as far as what they provide coverage for. So this is basically, like I mentioned earlier, is going to be insurance, liability insurance, in the event that a person that you're serving says that someone that works for you, an employee or volunteer, improperly touches them or creates some kind of physical issue with them where there's a complaint. Some insurance companies will actually provide the defense for the person that's being accused. Some won't. That's a really big deal, I think, because, you know, thinking about the folks that you have working for you, how much you're paying them an hour, and thinking that it would cost as much as $400 to $500 an hour for an attorney to defend you, make sure that this kind of insurance would protect and defend your employee that's being accused, because some of those policy forms just expressly exclude that. So this will pay for both damages and defense for an allegation that came out. Sometimes those allegations are totally unfounded. And so it's just really important that you have this coverage, because you won't get the cost of defense unless the coverage is in place. The other thing is on this is to just make sure the policy form includes those two things, both physical abuse and sexual abuse. Some policy forms only include sexual abuse and they won't include the other. So this is a really important thing to observe. Some insurance companies even will combine defense and damage under the same policy limit. So in most cases with liability, defense costs are outside the limit of liability, meaning the defense costs are unlimited and you're only limited by the amount of damages that you would be subject to if there was a claim. So in this case, many insurance companies are now combining defense and damages under one policy limit. So that means that there's one pot of money to draw from for both things. So I just would really recommend that you really review this to make sure you know what you're buying. Auto coverage, a lot of folks, you know, we work with don't have any owned or leased vehicles. So auto liability should still be considered because a lot of people will have employees or volunteers that drive their own personal vehicles on your behalf. There's an endorsement called non-owned auto liability that can be included here. So that coverage is basically going to protect the organization in the event that one of your employees was to be driving their own vehicle, for example. The vehicle accident that occurred was their fault. They were sued, you were named. So your interest would be covered in that claim. They would only be covered, the employee would only be covered on an excess basis because their own car insurance would always apply first, okay? So that's an important thing to note. It also can pick up something called hired auto liability, which means basically if you went to like Budget or Enterprise or someone like that to rent a vehicle, maybe you're going to take some kids on a camping trip or, you know, some kind of outing. You could actually waive the insurance for the hired auto liability from Budget or Hertz or whoever, because this policy can include that. And in some cases, you can actually pick up the physical damage to the vehicle too, by just making sure there's an endorsement to include that. That way you can just waive all the insurance coverages, you know, when you go rent the vehicle, because the insurance company that you would have would be covering that loss if there was one. So the auto liability is basically any kind of liability that you would have while driving a vehicle. So damaging property or damaging another vehicle or hurting people. Medical payments is just insurance for any person in the vehicle that gets hurt. So this is in your vehicle. So workers' compensation is always going to be primary for any employees. So this would be for anyone that else is in your vehicle. Maybe you have clients or other people that are there that are not employees. That would apply to them. Physical damage would be like what I mentioned earlier, related to the hired auto, but this would also include your leased or owned vehicles. There's something called uninsured or underinsured motorists. Uninsured motorist basically means that if you had an accident with someone that didn't have insurance and it was their fault, this would pay the bodily injury for anyone in your, anyone in your vehicle that got hurt. Again, workers' comp is always going to be primary. And then underinsured motorists is basically where you have an event where someone hits you and they have insurance, but they don't have enough to cover the loss. So that's another benefit there. Unfortunately, up here, Bay Area, we had a horrible claim a few years ago where there was a van full of people that had developmental disabilities, and they were stopped at a street light, and somebody in a brand new truck, like a big truck, was just coming up to the stop sign and didn't realize that the light was red. We're kind of thinking they were probably looking at their cell phone, and they hit the back of this van going about 40 miles an hour without braking. Unfortunately, one of the people with disabilities ended up passing away. The other people were really, really seriously hurt. This is where that underinsured motorist coverage came in. They didn't have enough, this person that hit them didn't have enough coverage. So our policy basically kicked in for the difference. But then there was lawsuits and everything from that, but it was a horrible claim. But it was good that they had this coverage in place. Most insurance policies will also pick up what's called rental reimbursement. So if you had a vehicle that was, it had a claim and you have it in the shop and you fixed, you could actually have coverage to rent another vehicle temporarily while that vehicle is being repaired. So it pays to actually rent the vehicle. Some policies will also pick up towing. So in general, towing is going to be picked up automatically in general if there's a vehicle accident where the vehicle can't be moved on its own. Your insurance policy will pay to cover the towing for that vehicle. Towing is not generally covered like a AAA kind of thing where you just, you have a flat tire, run out of gas or something on the freeway. They're not going to come out and pick up your vehicle, tow it away. It's not part of the insurance for something like that for most insurance companies. The policies will include volunteers as insured. So that's kind of a big deal to make sure that that's included. There are some really restrictive policies out there. Like, for example, companies like Progressive Insurance will have really strict guidelines on who can drive the vehicle. Like you actually have to approve every single driver and they have to be named in the policy for them to be insured. So if you don't have those people listed properly, they could basically deny the claim if there was one. So the policies that we write for our nonprofits generally have broad wording that include the organization, its employees, and volunteers. So that everybody's kind of picked up there. The last thing there is something called driver other car. And that's an example where, say like you have an executive director and one of the perks that they gave them, instead of giving them a raise, is they gave them a vehicle to use. And this executive director did not have their own personal auto insurance in their own home. They didn't have any other vehicles. This was their personal as well as work vehicle. So this driver of their car coverage is an endorsement that can be added to your policy that basically picks up personal auto coverage for when they're using it on their personal time as opposed to just using it for work. Directors and officers liability, also known as D&O, is basically nonprofit management liability or board governance. A lot of times board members feel like they need really high limits for this coverage because they want to be protected in the event of a loss. This is the only thing that this coverage really applies to is board governance. So if there was an auto claim or a professional liability claim or some kind of general liability claim, the board should be listed as insureds on those other policies as well. So generally, as long as the name insured, like we mentioned earlier, it includes the organization, its employees, and volunteers, those volunteers would be also considered directors, board of directors. Some insurance policies, most of the ones we use, will also include interns. So a lot of folks out there that have interns from local universities and things working for them, those interns would automatically be insureds as well. But it's a real, make sure you understand that distinction that directors and officers liability isn't just a catch-all coverage for directors of your board that covers them for anything. It only covers them for the basically decisions made in board governance. This policy can include something called employment practices liability. Those are claims involving things like wrongful termination, discrimination, harassment, claims like that. That represents about 99.9% of all claims that come from this kind of policy. That policy form can also pick up third-party coverage. So if you contract with someone else and you terminate their agreement and they sue you for wrongful termination, it can include that. Another big thing that this policy can pick up is something called wage and hour defense. We're seeing a lot of those claims right now where someone's being terminated for cause. They're getting an attorney to basically sue your organization, and the attorney will throw in a wage and hour type offense as well. It's really, really important that you really make sure that you are doing everything properly when you pay your staff, especially if you have any kind of 24-hour facilities. Those are really tricky to make sure that you're doing things properly. And we're seeing a lot of those claims where employers, even though they think that they're doing everything right, they're using good systems where they're clocking in, clocking out via apps or computers, but they're still getting dinged on a lot of extra fees that they're not paying attention to. So those are really quite costly for a lot of people. Another endorsement that could be added to this kind of policy is something called fiduciary liability. You would act as a fiduciary on behalf of employees when you place benefits, even though you use a third party. You could still be named in a lawsuit. Okay. Workers' compensation is basically a mandated coverage by most states that anytime you have just one part-time employee, you have to have workers' comp. California is one of those states that are like, it's like that. In some cases, it can include volunteers. And there's no exclusions for any kind of claim that someone has. So basically, if someone gets hurt in the job, workers' compensation is going to apply. The issue is going to be, is it a true industrial claim? So sometimes people will say they got hurt, but they can't really prove that it happened on the job. So there's all these different rules around workers' compensation where in California, the employer and the insurance company actually have up to 90 days to review a claim and just to make sure that it's truly a work-related claim. The catch-all there is this 90 days from the knowledge date that your organization has. So if someone was to come up to a supervisor and said, I think I hurt myself, and they didn't document it, and then 2 months later or 3 months later, they come in and say, yeah, I did get hurt, I want to submit a workers' compensation claim. That 90 days started with that, 2 or 3 months ago when that supervisor was made aware of that. We don't normally cover volunteers under workers' compensation. You can secure a separate accident policy for that if you like, a volunteer accident policy. That's the most common solution for providing coverage for the injuries of your volunteers. But the workers' compensation policy itself covers all the costs related to any medical care to an employee that gets hurt. It covers their lost time after they've been off work for at least 3 days. It'll even pick up benefits like if they have to be rehabilitated, permanent disability, all kinds of things like that. Property coverage would basically cover the things that you own or lease. So buildings, contents, things like that. It can include things like business interruption or business income and extra expense. That's going to be basically if you say your building burned down and you had to relocate temporarily, or if you were just going to lose money for not being able to operate, business income coverage would be able to provide coverage for that. The main thing there is that buildings and contents coverage under most property policies will not pick up things like earthquake and flood. So the business income is going to follow the same coverages that the property policy has in place. So it's going to cover the building and contents for things like fire, windstorm, hail, water damage except by flood. So water damage examples that would be included would be like if a pipe suddenly bursts within a wall and causes water damage. Some insurance companies will pay for things like toilet overflow, like or backup that causes water damage, things like that, or say water gathered on a roof and cause a roof to collapse. That could be considered a covered loss, things like that. Inland marine is something else that can be included under this property policy. Now, since COVID, a lot of people are still working remotely. They're bringing their laptops home. This would be a way for you to manage the insurance for that exposure. So if you provided them desks or whatever, computers and things like that, you'd want to address that kind of coverage through this type of form, because the building and contents form only covers building and contents at that location or within like 100 feet or 1,000 feet of it. So it's not going to pick up that coverage if it's at someone's house or when they're traveling or something like that. Crime coverage is the common things there, things like employee dishonesty or employee theft. That's employees that steal things or money that belong to your organization, or if they create some kind of fraud, like forgery, things like that. This policy form can also pick up things like computer fraud, funds transfer fraud, things like that. Equipment breakdown is kind of a weird term, but basically what it is I'll give you an example of a claim. Is say like there was like in San Francisco right now, we're experiencing crazy blackouts for some reason. I live in North Beach and I didn't have power from like 9 o'clock till this morning, woke up still dark. But say like the power went back on and then just blew out the electrical panel of our building and then caused everything with a plug to be destroyed or be damaged. That's what equipment breakdown policy would pick up. Say like if you had air conditioning units in your building and there was like liquid that was discharged from that had to be cleaned up with a special service because it's considered a pollutant, it would cover things like that. And then things like earthquake and flood can be picked up by separate policies generally. So other coverages, cyber liability is the first one we put there. That's a really important coverage to consider just because we're seeing a huge influx of cyber claims right now. Most cyber claims are all basically due to the error of an employee that clicks on a bad link. That's where most of them are coming. So cyber liability basically covers all the costs associated with the breach. So the cost for a forensics expert to come in and see how the bad guys got in, what kind of damage they did, if they're still in. It covers things like extortion. It can cover things like computer fraud, funds transfer fraud, cyber deception. Say somebody's trying to induce you to pay them money. You see those emails all the time, trying to get you to, they're impersonating someone else in your organization, trying to get you to send them money. Participant or volunteer accident coverage, business travel accident is also a nice benefit to consider. Foreign liability, so if you have any type of exposure where employees are traveling outside the US or its territories, you'd have to buy separate insurance for that. Workers' compensation, for example, would not apply if someone was going to a different country and they got hurt. They wouldn't be able to be treated there unless you secured foreign coverage. Special event insurance is basically most insurance policies that you have for general liability will be able to accommodate you for this. Many insurance companies even build in forms that include certain types of events automatically. So make sure that you review that with your insurance company to see what they'll include and what you have to basically tell them to add in the event of a loss. The one big thing to understand in this coverage is that most or all insurance companies that we know of will never insure a bounce house or any kind of inflatable device. So if you're ever planning to have one of those in an event and there's an injury, it's going to be completely excluded. So don't be aware of that. Don't get one of those inflatable devices at an event, or even if someone that if you're sponsoring an event and someone else within, like a vendor or something is going to have one, I'd strongly urge you not to let them do it, because you sponsoring the event are still primarily responsible for what happens at that event, regardless of who caused the injury. Okay. Excess or umbrella liability basically gives you the ability to increase your limits to higher amounts than what your primary policies will pick up. So most policies that you write for liability, we write for liability, can go up to a $1 million limit. So if you had a contract, for example, that required higher limits, you'd secure that through umbrella or excess liability. Bonds are just, they're not really considered insurance necessarily, they're just more like a guarantee for something. So you may be required to have a bond by like a licensing agency. Community care licensing is a really big thing that provide, that requires that. So bonds they're going to be a specific amount that you have to insure for, and they're basically a guarantee. So it just means that that bonding company is going to guarantee whatever that bond is saying it'll require. So like for a community care licensing bond, for like $2,000, it's for like a home for people with developmental disabilities. That means that if, say, somebody that lived in the home, a person with disabilities, and something went missing, like their iPad got stolen or something, the bonding company would pay to replace that, but then they go after the responsible party and make them pay it back. Okay. So here you go, Sarah, take it away.
Cole, before we move to Sarah, would you mind if we ask a few questions? We have a few questions from our—
Sure, yeah, please.
Yes, so there is the first one. Are there any movement by insurance companies or broker to band together organization with like interests like churches, service clubs, youth service groups to help spread insurance risk? For example, by spreading insurable asset across a wide geographic area.
Yeah, so you're talking about group programs. They're really interesting. I mean, there are certain programs that can be good like that, but in general, there's so much availability now for insurance for nonprofits, as well, for securing them directly, that it doesn't really necessarily benefit most people when they try to do a collective thing like that, because you can get it on your own at a pretty competitive cost. I've been doing this over 25 years. When I first started working with insurance, nonprofit insurance, there were very few insurance companies. Those kind of programs were really popular at that time. Now they're not as popular because it's just the availability of coverage from multiple insurance companies is really strong out there. We do a lot of program business where we work with certain types of groups. Like, for example, we have a museum program where we're connected with the California Association of Museums. And so we have developed a program where we have exclusive rates for any member of the California Museum Association. Other programs like Head Start, things like that, we do as well, where we can give you better rates because you're a member of a association like CAM or Head Start. Does that help?
Yes. Thank you, Cole. There's another one. For auto coverage, are we required to track and keep on file the employee's driver license and personal insurance proof? Does the insurance company run driving records and communicate anyone that is not eligible for coverage? Yeah,
so most insurance companies will want you to give them a list of drivers. Some do, some don't. But in general, they do want to know who's driving. They will run motor vehicle reports on all those drivers to make sure that they comply with their minimum driver guidelines. So when you buy personal auto insurance, the auto insurance company runs your record. They see you have like 2 speeding tickets or an accident, and they're going to charge you more because you have those violations. That's not the way it's done on the commercial side that we work in. They just have these guidelines that say, okay, they can't have more than this many accidents, this many tickets or whatever. They can't have a drunk driving, for example, if it's more than or less than 5 years old, things like that. And they don't charge more. They just say that person's not eligible to drive. Okay. Most insurance companies will also require that you have an internal policy in place that checks on the existence of a personal auto policy at least annually for anyone that drives on your behalf. So that can be just collecting an auto ID card each year and then just keeping it internally. You don't have to give that to the insurance company. You just have to tell them that you do have this policy in place and that you make sure it's done. Some insurance companies will even require that you have certain limits of liability that you impose on your employees. Maybe they have to have at least $100,000 in personal auto coverage, with certain insurance companies. The other thing I would say to this too is make sure that in your employee handbook, you have a policy about using personal vehicles. Because in many cases, what happens is that the employee understands they have to use their vehicle, but they don't disclose that to their own personal auto insurance carrier. And so they have an accident. If their auto insurance carrier finds out that they're using their vehicle for business and they didn't disclose it, they could deny the claim. And then what would happen then is if you had this coverage called non-owned auto liability, that whole claim would be picked up by your agency. So just be aware of that. And that could cause a big claim against you. Okay.
Great. Thank you, Cole. We have a few other questions, but for the time right now is 1:36. I think we'll move to Sarah and we can go back with the question. Take it away, Sarah.
Thank you so much. I'm grateful for the opportunity to make a presentation this afternoon, and I'm happy to see so many of our current insured groups in the participant list. I'm going to try and keep it relatively brief because I think the greatest interest is really with the property and casualty coverage, and I want Cole to have an opportunity to answer those questions. You want to go to the next slide? So group insurance is, the definition is not that a group of employees are banded together to acquire insurance. The definition of group benefits is that there is an employer contribution. So when there is an employer contribution, you could have one employee and have group insurance in place. So the most typical types of group insurance are the medical that we're all familiar with, dental and vision coverage, life, group life, voluntary life, accidental death and dismemberment. Disability coverage is a coverage that probably most people don't understand what exactly that is. So I'll spend a minute on disability. Group disability policies coordinate with California state disability income. So if you have a policy that says it'll pay 60% of an employee's pre-disability earnings, that means that the majority of that 60% is likely going to be paid by the California state disability income. So for the first 365 days, unless that employee makes more than $94,000, the disability policy is going to just pay a very minimal amount. The group disability real benefit is the long-term disability that starts at the 365th day when California state disability income ends. So it's a good thing to review that disability policy to make sure that you're not paying for a coverage that all or most of your employees are not going to receive a benefit on if the elimination period, the period in which a person is out on a disability, is shorter than 365 days. Group acupuncture and chiropractic is typically a rider to the medical coverage. And then the flexible spending, Section 125, Section 132, health savings accounts, all of these are sort of additional vehicles that allow some tax advantage savings. On almost all benefits, the employer needs to have the core benefit in place. Not that all employees have to be enrolled upon it, but the core benefit is the group medical. And then typically the rest of these benefits are added to it. Employee assistance programs. Who would have ever thought before the pandemic that an employee assistance program would be so important? So many employers were so happy that they had these in place during the pandemic because it really presented an opportunity that supervisors and managers could instruct their employees to go to the employee assistance program for various type of urgent crisis mental health services, legal questions, and general support, relieving stress and so forth. And then the wellness programs typically are all rolled into the medical coverage. There are some benefits through employee assistance programs for wellness, but typically the group medical is going to be the vehicle for the wellness programs. You want to go to the next slide? So I think we're all familiar with the current mandates, the Affordable Care Act. One thing about which almost every call that I get from new nonprofits that's entering the market, the Affordable Care Act does not have a mandate for an employer to offer benefits if you have less than 50 employees. But if you do offer benefits, the full time for benefits is 30 hours per week. The employer cannot set a full-time hourly amount. It cannot be 32 hours or 40 hours. It is, according to the Affordable Care Act, regularly scheduled 30 hours a week or more. Now, employers do have the option, especially in small group, and small group is if you have 1 to 99 full-time equivalent positions. You do have the option to offer benefits to employees who work 20 hours a week or more. So those are really the two options for employers for eligibility, 20 hours a week or more, or 30 hours a week or more. And if you are an employer with 100 or more full-time equivalent positions, then you know that you are required to offer benefits or pay a penalty. I'm not going to get too much into the details of that because in the interest of time. You want to go to the next slide? So again, this is part of the employer mandate that if you have 50 or more employees, you're going to face a penalty if employees go to the exchange or your coverage is not available to all full-time employees and their children. Interestingly, spouses are not required to be covered. There was a big change in the Affordable Care Act that happened January 1st, and I want to make sure that everyone understands what it was. Prior to January, the formula on which you could receive a premium subsidy was based on whether you were offered coverage through your employer, the employee, that was both affordable and met the minimum standard by the federal definition. And if you were offered coverage that met those two criteria, you were not eligible for premium subsidies through Covered California, but neither were your family members, even if the employer did not contribute towards their coverage. That all changed on January 1st. As of January 1st, if you, the employee, are not eligible for premium subsidies because your employer offers you coverage, your family members can still be eligible for premium subsidies if the employer is not contributing to their group coverage. You want to go to the next slide? So I think we did talk a bit about the group versus individual. Group coverage is when the employer is contributing to the coverage, and individual is really not meant for employers to be contributing to. And there is quite a bit of liability when an employer is contributing to individual coverage. There are some vehicles now that allow the employer to contribute to individual coverage, and those are namely the Qualified Small Employer Health Reimbursement Arrangement, and the ICRA is the acronym, but it's Individual Coverage Health Reimbursement Arrangement. Those two IRS vehicles allow an employer to contribute towards individual coverage, but those are the only two circumstances in which an employer may pay for a premium that's individual. If you have either one of those in place, you may not have group coverage in place. And there's some rules about the ICRA that certain classes of employees that you designate could be on the ICRA and you could still have group, but it's super complicated. Those ICRA plans are pretty much in their infancy, and they are a little challenging to administer, especially if there is an employer and an employee contribution towards the insurance. But group coverage is really what's meant for employers to have in place for their employees. So in this environment where it's so challenging to find employees, it is a really good recruiting and retention tool. Employer plans do have better coverage. And then, of course, the premiums are both tax advantage at the employer and the employee level, those shares. You want to go to the next slide?
Sarah, just a quick questions about the
Mhm.
previous slide. What is a redetection tool?
A redirection tool, I think that was a typo in that slide. Not, it shouldn't say
Oh, wait,
redetection, it should say redirection
Oh,
or
okay.
retention. I'm sorry, it should say retention tool. Not
Thank you.
redetection. I don't even know that that's a word. It's retention. It should say recruiting and retention. Go ahead and go to the next slide. So I think we just covered this to avoid potential IRS penalties and liability. Employers can only reimburse employees for individual health policies through a qualified small employer health reimbursement account and also an individual coverage health reimbursement arrangement. So before we get into the sort of the rules around employer sponsored plans, I think that it is in all employers' best interest is occasionally, if you're a very large employer that has more than 100 full-time equivalent positions, maybe every year on the off cycle of your renewal. So let's say that if you renew January 1st, maybe July 1st, you have your broker do an analysis of your coverage. It's very difficult to do this at the time that you're doing your renewal. And so that's why I recommend that 6 months after your renewal, you really look at your plan and make sure that your participation rules are correct according to your contract, as well as the contribution, that you're obeying all of the San Francisco rules about coverage, and then that there's not any irregularities that have slipped into the plans. So it frequently happens that an employee will come to you and say, for example, I'm on my spouse's plan. So instead of being on your group plan, can you raise my salary? Or can you reimburse the premium that I have to pay to be on my spouse's plan? You have to be very careful about that because the IRS has something to say about what has to be in place to allow for those sort of irregular positions that you're going to take with employees. I think we're probably all used to that a waiting period could not exceed 90 days. And that means that new hire waiting periods can really only be 0, 30, or 60 days because coverage always begins on the first day of the month, typically. So if you have a plan that begins on the first day of the month, your waiting period really cannot be 90 days for medical. And this really applies just to medical, not to other ancillary coverages. But all of these documents that are required if you have an employer-sponsored plan should be reviewed when you have that benefit analysis that your broker does. And so they need to make sure that you have all the IRS documents in place and you're providing all of your employees with the documents that are required by the state and federal government. You want to go to the next slide? So CalNonprofits Insurance Services, we're the social enterprise project of CalNonprofits, as was said before. And we do have some super good plans. One of them is the Nonprofit Benefits Trust that we've had for, I think, 40 years now. And that is a dental vision trust. You're pooled with all other nonprofits that participate in that trust. You are CalNonprofits members to participate in it. And those premiums stay very stable and have been very popular over the years. We also have available to you the Unemployment Services Trust. We have exclusive UNIM programs for group life, voluntary life, disability. We do have an exclusive landmark rider that follows health insurance. Our CEO, when she came on board, Colleen, she changed us over to all paperless. And wow, that was so great because when the pandemic hit, we just didn't miss a beat and we're able to continue on serving you, our clients. And then we do provide some administrative services for our groups that are very valuable. One of them is mineral. And I think one of the most popular things that groups use within mineral is they have like a PDF filler, a machine that can help you build your employee policy handbook. And then it will send you updates as California and federal law changes. But the mineral also just supplies day-to-day HR help. You can ask a question via mineral and you'll get a direct answer specific to you. And it does that by state. And so it really helps you stay in compliance with your HR department. You want to go to the next slide? So I often get this question or presented with this when a group contacts us and they say, well, our board has tasked me with getting 3 to 5 quotes from different brokers. So the broker doesn't set the premium. The premiums and the plans are set by the insurers. And so if the plan and the census is equal, the price is going to be all the same. It does not vary from broker to broker. And when I'm making that statement, it applies to small group coverage, those that have fewer than 100 full-time equivalent positions or are larger than that, but on small group coverage. So there's many employers that would be eligible for large group, but they stay in small group as long as possible for the utilization and the pool to be a larger entity. So if you're a small group, you're not really searching for a lower price because the plan and the premiums are the same regardless of what broker you use. What you really should be shopping for are the additional services, what we call the value-added services that you get with that particular brokerage. So when you're searching for a plan, you should really be searching for those value-added services. And then next thing that you should do is make sure that your broker understands what your budget is, and then you can go forth and what your employees' needs are, go forth to get quotes. Now in large group, the variant in that process is that the broker earns a commission, and that is stated what the commission percentage is going to be. So if you look at your 5500 form, you can see how much your broker has earned in commission in a year, and you should know the percentage attached to your medical plan. And that is something that's entirely negotiable, but only for large group coverage, not for small group coverage. Small group coverage, those commissions are set by California Department of Insurance. You want to go ahead and go to the next slide. Okay, so this is your opportunity to have the monitor read your questions, either employee benefits or COLS, property and casualty.
Yes, Sarah, we have a question. Can an employer offer a medical insurance stipend to cover Medicare?
It depends on what size you are, but generally no. So you can't offer just a stipend for people who have Medicare. The IRS allows an employer to offer what's called cash in lieu of benefits, and that would be applicable to all employees who could show proof of other creditable coverage. So it depends on what size you are. If you are an employer with less than 20 employees, other creditable coverage is Medicare, Medi-Cal, TRICARE, and other group employer sponsored coverage. Those are the only 4 coverages that an employee could waive your group coverage and receive cash in lieu benefits. If you are a group over 20, Medicare is taken out of that as creditable coverage because the federal government does not want to be the primary payer for someone who has Medicare. So
Great.
creditable coverage that you could offer cash in lieu of benefits for a group of 20 or more is only Medi-Cal, TRICARE, the veterans coverage, and other group employer sponsored coverage. But you have to offer it to all your eligible employees, not just those with Medicare. There's a huge fine for that if you have 20 or more employees.
And can an employer reimburse a staffer who choose to go on their own spouse's plan?
Again, only through cash in lieu of benefits. So that would be the same scenario that someone showed proof of other group employer sponsored coverage and they could receive the defined cash in lieu of benefits amount.
Great, thank you.
It is taxable income, cash in lieu of benefits. There actually is no such IRS vehicle called a health stipend.
Thank you. And are chapters of parent organizations under their insurance, or should they get their own insurance? And do you only cover California-owned businesses?
Is that for property and casualty or medical? You want to answer it, Cole? It sounds like it's property and casualty.
Normally, chapters can be included under liability policies as long as there's some sort of insurable interest we can establish. So it would just be based on the particular risk. We'd have to review it and see if it's combinable.
Awesome. Thank you. We have a lot of great questions here. We are a small nonprofit with 2 volunteers right now. How do we protect ourselves from lawsuits? We are getting stuck on the coverage for volunteer versus ironclad waiver to sign. We don't have money to pay a lot for insurance. Also, is the sexual misconduct a separate insurance, or does it cover volunteers too?
Okay, that's a lot of questions. So typically, you want to buy insurance for what you have an exposure for. So without knowing what you guys really do, the most important coverage to get would be general liability, number one, because that's going to cover any bodily injury or property damage to a third party. If you only have volunteers, they'll be insured as just like an employee. If they get hurt, then you can secure a volunteer accident policy. The only time volunteers are covered by a general liability policy is if they can prove that the injury was due to the organization's negligence. Like they are the ones that caused the injury. So that's that. So general liability is the most important thing. I'd say the second important thing would be the directors and officers liability. The abuse coverage that you mentioned can be endorsed to the general liability form, and it would cover volunteers if they were to be accused of any kind of sexual impropriety or physical abuse or anything like that. That would cover them as volunteers of your organization.
Thank you, Cole. Another question, if our professional liability insurance policy provide coverage for officer of the agency, does this provide adequate coverage for directors and officer?
You know, I think that came from a legal firm. Some organizations that provide, some insurance companies will provide an insurance policy that covers professional liability, directors and officers liability, general liability, everything. So because those are non-standard forms, the only way we can really answer it is by reviewing the policy. There's no way I could answer that question with any integrity without really understanding what's there, because all those policies are non-standard, like we talked about earlier. So in some cases, those policies will only cover like sub-limits for employment practices liability. They won't be the full limits on the D&O. I've seen that. But you'd really have to have someone review that for you.
Yeah, that makes sense. Thanks, Cole. And is worker comp required for contracted employees?
That's a great question. That goes back to that law that passed a few years ago called AB5 here in California, where basically some types of employers, for example, like those working in the arts, would be required to cover independent contractors under their workers' comp policy. So my understanding of the AB5 law says that you basically can't contract with the position that you currently have an employee doing the same thing. That's kind of the rationale, I think, behind that. So you'd have to refer that to your attorney to make sure that you understand what would be required, or go to your insurance broker and ask them based on what you guys do and determine whether or not that AB5 rule applies to you.
Thank you. And the very last question, do you need to offer dental vision insurance to temporary employees? The California temporary employee?
No, because group benefits are only for regular employees. They are not for temporary interns on call. So you need to refer back to your insurance contract and see if it includes voluntary coverage, but typically it's always for regularly scheduled employees, and the employer gets to set the eligibility at either 20 hours a week or more or 30 hours a week or more.
Thank you. We have a lot of questions, but it's 2 already. So if you have any questions, please feel free to contact Cole and Sarah directly. Their email address is right here. Thank you so much, Cole and Sarah, for the wonderful, very informative presentation. Thank you all for joining us this afternoon. If you have any questions, please feel free to reach out to them. I also put the link that you can request a consultation or a quote from CNIS. Feel free to reach out to us, CalNonprofits, at membership@calnonprofits.org if you have any questions. And I hope you have a wonderful afternoon. Thank you so much for joining.